The Brazilian agricultural sector generates approximately 2.5 trillion reals annually, representing a full quarter of the nation's GDP. It pushes over $160 billion in exports into the global market every year. Yet the entities executing this massive physical output operate on structurally constrained profit margins, averaging only 5 to 15%. This chart shows the macroeconomic asymmetry of the sector. While Brazilian commodity producers generate overwhelming physical volume at single-digit margins, global multinational processors like Unilever and Nestlé capture the wealth, operating at margins between 15 and 40%. The system suffers from a specific structural bottleneck. Brazil executes the most capital-intensive, high-risk phase of the supply chain, pulling raw calories from the ground, but completely relinquishes the high-margin phases of transformation and brand equity. The traditional response to this has been a linear growth mindset, acquiring more acreage and increasing crop yield. But optimizing a low-margin process only yields more low-margin output. Increasing agricultural yield is strictly a volume strategy. Capturing the remaining 85% of the value chain requires an entirely different corporate architecture. The corn supply chain provides a precise microeconomic model of how value is actually generated. This ledger tracks the exponential expansion of margin. A standard unit of raw commodity corn is valued at approximately 2 reais. Through basic industrial transformation, such as microwave packaging, that exact same physical input scales to 15 reais. Pushed into a specific consumption environment, like a cinema, the price expands to 40 reais. At the absolute peak of the chain, configured as a premium branded product like truffle popcorn, that unit commands over 100 reais. The chemical composition of the corn did not change. The 50 times price expansion is engineered entirely through industrial processing, distribution, and brand equity. Capturing a 50 times multiplier at a national scale is impossible for isolated farming operations. It requires integration into a structured, tiered ecosystem, the IBRA framework. The IBRA architecture is a decoupled 3-tier ecosystem, separating operational risk from commercial execution. Layer 1 is the institutional base, operating without a profit mandate. Its sole function is applied R&D, connecting science with agricultural execution to validate new product structures. This layer is financed entirely through tax-incentivized capital. Companies operating under the lucro real tax regime, which calculates corporate tax based on audited net income rather than presumed revenue, can legally redirect up to 4% of their owed tax directly into this institutional layer. This funding mechanism absorbs the high failure rates inherent to early-stage product development, completely removing the need for expensive, ROI-driven venture capital during the discovery phase. The direct output of this layer is a continuous, heavily vetted pipeline of market-ready technologies and consumer products. By utilizing tax incentives to fund R&D, the institutional base acts as a financial shock absorber. It isolates and neutralizes the heaviest risks of agricultural innovation before a single dollar of private equity is deployed. With technical risk neutralized, the system integrates private capital. Layer 2 is the capital holding, the strategic brain organizing investor funds and defining commercial theses. To commercialize research, the holding creates special purpose vehicles, or SPVs, for individual product lines, isolating financial risk. The capital dynamic here shifts entirely. Investors entering the holding layer are allocating private equity with the strict expectation of aggressive financial returns. To maintain efficiency, governance boundaries are rigid. The holding dictates high-level capital allocation and macro strategy, but it is explicitly walled off from daily operational execution. It operates as a strategic firewall, converting academic science into highly investable, ring-fenced corporate assets. Layer 3 consists of the operational companies, where economic capture occurs. These entities have 3 strict mandates: physical industrialization, rapid construction of brand equity, and active commercial sales. Built for global distribution, they bypass domestic limits to capture strong currencies. Returning to the initial baseline, this operational layer is the physical engine room that takes the 2 real commodity corn and processes it into the 100 real premium export. Layer 1 removes the risk. Layer 2 organizes the money. Layer 3 is the execution zone, where massive margins are finally realized. Agriculture's default scaling mechanism is linear. Doubling revenue requires buying twice the land and planting twice the seed, creating a hard geographical cap on growth. The IBRA framework bypasses linear limits through the tree of brands. Instead of scaling a single operation, a validated raw material base is continuously recombined into multiple product lines. Sharing underlying R&D and logistics causes development costs to plummet with every new venture. The structure transitions from a collection of isolated farms into a self-reinforcing ecosystem. It leverages the rapid deployment agility of a software conglomerate, but it is backed entirely by hard, physical agricultural assets. The tree of brands severs the link between revenue limits and raw acreage, providing a mathematical pathway for exponential scale. Zooming out from the corporate mechanics, we can analyze how this architecture functions at a macroeconomic level. The framework aligns closely with the work of economist Joseph Schumpeter. Schumpeter argued that economic development is rarely achieved by merely expanding existing methods of production. True growth is generated by the radical recombination of existing resources into new, higher-value structures. We can map this directly onto Michael Porter's value chain theory. The IBRA ecosystem systematically shifts the economic center of gravity. It pulls capital away from the capital-intensive inbound logistics of farming and forcefully allocates it toward outbound marketing, branding, and margin extraction. This system is not attempting to invent new methods of planting seeds. It is engineering a superior corporate architecture designed to extract maximum capital from the agricultural resources Brazil already commands. This theoretical repositioning maps directly to hard financial projections. This side-by-side projection models the mathematical impact. In the legacy commodity model, 100 million reals in revenue yields a fragile 10% margin. Processed through the integrated IBRA model, that identical physical volume projects 300 million in revenue at robust 20 to 30% margins. A 3-time scale in gross revenue yields up to a 6-time scale in net profit. The macroeconomic target of this system is the cultivation of a multi-brand ecosystem capable of sustaining a 1 billion real global valuation. The most difficult variable, securing the physical raw materials and the sheer scale of production capacity, is already conquered. It is currently waiting in Brazil's soil. The objective is no longer agricultural volume. The objective is architectural reorganization. It is time to take a system built to supply the globe and re-engineer it to profit from it.